Chapter 6, Deductions and Losses, Part 2. The accrual method. Taxpayer can deduct amounts paid if both criteria are met. 1. All events test, and 2. Economic performance, EP test. All events test, there's 2 requirements. The existence of a liability is established. Second one is amount of liability is determined with reasonable accuracy. The exception to economic performance test must meet all criteria. So the all events test met during the year. The economic performance occurs within 8.5 months after close of a tax year. The expense is recurring and the taxpayer treats as incurred during the tax year, not material or better matching. Then it is deemed to be met. Wash sales. We discussed wash sales in the beginning of the semester. So with them is generally losses of sales of stock or securities are disallowed in the year of sale if 1, the taxpayer realizes a loss on the sale and acquires substantial identical stock or securities within a 61-day period. The period extends from 30 days before and after the sale. The exceptions: dealers may recognize losses. The intent was not to generate an artificial tax loss. Related parties disallowed losses. Original seller receives no tax deduction. The purchaser's basis is going to equal the amount paid. Upon later sale of property, purchaser may deduct recognized gain by disallowed loss. If disallowed loss is greater than the gain, then the unused loss will disappear. Related parties, an individual's family. So you have spouse, lineal descendants, brothers, ancestors, half-siblings, and sisters. Other related parties. Individuals are greater or equal to 50% of the value of a corporation's outstanding stock. Grantors, beneficiaries, and fiduciaries of a trust. Between a corporation and a partnership, if each owns greater or equal to 50% of each other. Or between 2 corporations, at least one is an S Corp if one person owns greater or equal to 50% of both. Attribution rules. Stock owned by family deemed owned by individual. The partner who owns a stock in a corporation is attributed stock owned by another partner. Stock owned by entity deemed proportionally owned by shareholders, partners, or beneficiaries. Craig and Alice are married. Alice is attributed to Craig's 40% of first. Alice is not attributed to Beth's first stock. If Alice sells property at a loss to first, she will then be able to recognize the deduction. Okay, so Craig, he is the first, Beth is the first. So Alice is attributed to Craig's 40% of first. Alice is not attributed to Beth's first. So they will be able to deduct that loss. All right, Craig and Alice are married. Alice is attributed to Craig's 25% of the first. Alice is attributed 25% of first through the AB partnership. Beth owns directly 25% first and attributed another 25% through AB. Alice is attributed Beth's deemed and actual ownership and therefore is considered to own 100% of the first. Alice cannot recognize any losses on property sold to first as per section 267. Hobby losses. The taxpayer is presumed to have a profit motive if he or she can show a profit for 3 out of 5 consecutive years. The IRS then will have burden of proof to disprove the taxpayer's position. If activity is considered a hobby, then the taxpayer can deduct expenses only up to the amount of the gross income. Vacation homes. The property equals the residence if the taxpayer's personal use exceeds the greater of the following. If it's used more than 14 days, or 10% of the number of days of the property is rented at fair market value. If personal residence versus rental unit, then the amount of deductions may be restricted under Section 280A. The vacation home category, there's 3 categories. Primary personal, if it's rented for less than 15 days. Mixed personal and rental, rented for greater than 15 days, and personal use exceeded the larger of the 14 days or the 10% of rented days. Or 3, primary rental, rented for greater than 15 days, and personal use did not exceed the larger of the 14 days or 10% rented days. Vacation homes, the tax impact. Taxpayers may exclude from gross income the rental income received, but may not deduct expenses related to the home other than the itemized deductions allowed for property tax and mortgage interest. On a mixed personal rental, the taxpayer must report in the gross income all the rental income and may offset allocated rental expense income. A rental loss is not allowed. Losses are carried forward and are deductible against the subsequent year's rental income. Or primary rental, taxpayer must report all gross income, all of the rental income, and may offset all allocated rental expenses, even if resulting in a loss against the income. So on these two, on 2 and 3, that's where you're going to file on your Schedule E. The vacation homes, okay, so you're going to see if it meets the residence test. If it meets the residence test, is it rented over 14 days? If it's yes, you're going to go through these categories. If it's no, you're going to have category if the income is not reported. If it doesn't meet the residence test, then you're going to come down here and you're going to look at your category 3. Okay, and then you would have different rules. Your passive loss rules would apply, and we can talk about that. Personal use of property includes taxpayers' family use, property or personal use, unless charged fair market value rent, properties being used under reciprocal use arrangements. Any day fair market value rent is not charged. Vacation homes, allocation of expenses. Expenses must be allocated between taxpayers' personal or rental use. If the taxpayer has personal usage greater than 14 days, divided by 10% test, then you can deduct expenses only up to the gross rental income on the Schedule E. So on that one, you're going to have your personal usage, if it's greater than 14% or 14 days, or the 10% test, not divided, or the 10% test. Excess losses, they're going to be carried over, so you're going to be able to carry them. If personal usage is less than 14 days or the 10% test, then deductions must still be allocated, but are not limited. The formula for the rental use expenses equals total expenses for the year times the number of days rented divided by the total number of days used. So you're going to get a fraction on the rental days divided by how many days you used it, and it's going to give you a percentage, and that's going to give you a percentage of your total expenses for the year. And that concludes Chapter 6, Deductions and Losses. Thank you.